Hello and welcome back. Francois, hello.
Hello, Mark.
Thank you for joining us. I've titled this video Equity Buying Levels and the Financial Condition Index. I'd like to talk about those two things and then German stocks, gold, US dollar, and the luxury sector if we have time. First of all, coming to equity levels, we've reached your target in the S&P 500 now, 5,500. Are you happy that conditions are right for coming back into the market now?
Not really. I think that what we had in terms of development in the course of the last 10 days, despite the fact that we rebound from the level that you mentioned, the 5,500 on Friday, are not particularly good. They are not telling us that there is a buying opportunity or screaming buying opportunity right now. There are different elements. I think that at the end of the day, what happened in the market in the course of the last 2 weeks is a deterioration in the confidence among investors. It's quite clear. And for example, when you look at the Michigan Consumer Index on Friday, it was not particularly good. It was going down quite significantly. And what is interesting also is that inflation fears are rising. Moreover, the volatility, the VIX index, has settled up a little bit lower on Friday, but nevertheless, it's on an upward trend. And as you mentioned, financial condition index are not particularly good. And what is interesting is to look at the widening of the spread of the credit market versus the treasury bond. And this has widened quite significantly, both for investment grade and high yield. And this is not something that is telling me that the conditions are right to jump into the market right now, and that you need to be patient in terms of assessment of what is going to happen in the coming weeks.
What is the event you would wish for? Could it be political or otherwise that would reassure you to come back into the market fully?
I think that there is a lack of visibility when it comes to the policy of the Trump administration that is weighing on market sentiment. I think that it is very difficult, and we all know that by April the 2nd, the Trump administration is going to come with more tariffs and more elements on the front of the quote unquote trade war. I think that the reaction of Europe last week to the decision of Trump concerning steel and aluminum was quite strong. So I think that people need to have more visibility on that front. I think that also we have a week where we will have important numbers coming, because we will have today, I think, the retail sales in the US, the industrial production will come out. And those two elements are very important because they will tell us more about the development of the economic situation in the US. I think that what is also important is what is going to happen in Europe. We will have the vote by the German parliament this week about the spending program that was initiated by Mr. Merz, and the fact that the fiscal limit is going to be modified. So you still have a lot of things coming. And now there is also something that is looming for the medium term, which is Mr. Trump going to come out with a tax cut program? This is something that people are expecting, or is it impossible for the Trump administration to move forward with such a development?
Coming to the financial condition index, there's lots of these. Without going into the smaller nuts and bolts, which one do you follow? What is it, and why do you incorporate it into your decision-making process?
Because at the end of the day, financial condition index is an index that was built originally by central bankers, one of the big central bank, G7 central bank, and then it has been moving forward with some adaptations in major banks. You have, for example, the Bloomberg Financial Condition Index that you can follow on your Bloomberg screen, and is giving you a good sense of what is the kind of liquidity that you have in the market, and liquidity, especially in the financial sectors. As I mentioned, when you have a widening of spreads, when you have interest rates going up, when you have equities going down, those are elements that are taken into account and bringing the financial condition index down, which means that there is less liquidity in the system. So it means that potentially you have more tension into the financial and banking system, and you need to be careful with this index. And that's exactly what I'm looking. And that's the reason why lately I have been worried, because clearly the financial condition index is coming down quite a lot in terms of the last few weeks.
All right. Well, if the US has been going down, I think all the major indexes have reached correction territory of down 10%. The opposite is happening in Europe, especially in Germany. Germany's been gangbusters the last few weeks. What are your comments on German stocks and the announcement on Friday that possibly an agreement had been reached on the debt brake?
This is one of the major factors that is pushing the market higher. And the fact that at the end of the day, what is also very interesting in terms of this move concerning Europe versus US, we all know that since the last quarter of 2024, there is a rebound in European equity, German equity in particular. The cyclicality of the German stocks index is appreciated by investors. The fact that lately you had some earning revision coming from the European equities is something also that is supporting the European and the DAX index. And the notion that potentially that the fiscal break is over means that you have more room for a kind of economic rebound in the major European economy, which is Germany. So it is those are all the elements that are supporting the run up in German stocks in the course of the last few months.
Would you say that European financial conditions are strong enough, especially the news in Germany, to overcome the overhang of possible Trump tariffs?
I wouldn't say so. I would say that, at the end of the day, the global economy at the end of the day is most of its financing needs are in US dollar, which is the reserve currency. So if something is happening in the financial condition index, which is spreading into the financial and banking system, which is not what I am saying. I'm just saying that there is some kind of warning sign. For the time being, you cannot say that the financial system or the banking system is infected. But if that is going to continue, I think that Europe financial conditions are not necessarily very relevant compared to what is happening in the US.
Coming to gold now, gold is headbutting against its all-time high of $3,000. Your target's 3,100 now, I think. Have you revised that, or do you expect us to see that quite soon?
I think that 3,100 is the first objective that we could see in the coming months. And this is another element at the end of the day, which is telling you that there is no hurry to jump into the equity market. Because the fact that you had the gold price being able to cross the 3,000 mark last week before consolidating a little bit is telling you that there is some fear among investors. And I think that this is another element that tells you do not jump into the equity market right now.
Coming to the US dollar, or maybe I should say the euro, because the euro has been quite good the last few weeks. Although the dollar has been catching up against the other currencies like sterling and the Swiss franc. Are you expecting the move in the euro to continue against the dollar?
The dollar, the euro has been supported by a major factor, which is the development that you had in Germany, which the victory of Mr. Merz and the fact that he was very quickly going for a change of course in terms of the fiscal limit. It has brought quite a significant tension on the Bund 10-year, and we are close to 285 this morning. It's a significant move, so it's really the euro has been supported by this increase in interest rates in Germany. And it has also been supported by a factor that is interesting, is that when you look at economic surprises in Europe have turned up, while in the US they have turned down. This is another factor that is supporting. Is it going to continue? Can we expect that we go very quickly to 110, 112, 115? I would not say so. I think that we are in a consolidation phase for this euro US dollar exchange rate in the coming weeks. 105, 110 should be the trading range that we could see. What is interesting is that you have less and less people believing that we are going to see parity on the foreign exchange pair. That is something quite major. You had a turnaround in positioning by investors. So consolidation in the short run. I think that by the end of the year, you could see 112, 115 on the euro US dollar exchange rate. And there is a big element that we need to take into account, because this is something that investors have also in their mind, is the question, is the Trump administration still defending a policy of a strong dollar? You have a lot of observers that are telling that the Trump administration is going for a lower dollar. So this is something that we need to watch very carefully.
Coming to the luxury sector and Kering in particular, Kering announced a new artistic director called Demna, I think. And the stock immediately went down by 12%, which is not what they were hoping for at all. I don't think they'd have been able to predict that. What is your commentary on what's happening at Kering? It's down
I th-
70%, by the way, from the high.
yeah, I think that this is connected, first of all, to the global environment, which has been less supportive for luxury sector, the luxury sectors in the course of the last few weeks. Even Hermes or Louis Vuitton suffered, but Louis Vuitton was connected to the tariff on wine and champagne. There is a specific element with Kering, which is everybody knows that the profitability is coming from Gucci. Or all the goods or the bad can come from Gucci, because this is a significant part of their business. You know that a year and a half ago, they decided that, what was called the maximalist luxury Gucci was over, because it was too shiny, and so they decided to cut this trend and to go for somebody who was more minimalist in the way. And they decided to hire an artistic director that they fired 2 months ago, because it didn't work, because the sales were not coming up the way they were expecting. So what did the market not like? The fact that the new artistic director, which was the artistic director of Balenciaga, is known for, again, to be a maximalist kind of fashion designer. So there is some kind of questioning among investors. Is Gucci going to be able to go through a turnaround? Because they moved from maximalist to minimalist, again to maximalist. So what do they want to make out of Gucci? So that's the reason why the stock suffered that much. Now the guy needs to convince that he is not going to try to change completely again the brand from minimalist to more flashy. This is not an easy task, and that's the reason why you had such a reaction on Kering in particular.
Coming to, for instance, the S&P Luxury Goods Index, I'm not sure if that's something you look at or not. It covers 80 of the largest publicly quoted luxury stocks. Is it useful to you, or is it so diversified that it's just a reflection of emerging market wealth creation?
No, I think I still believe that you need to, when you consider the luxury sector, you need to consider the specific brands, or the specific Hermes, Moncler, or Ferragamo, or anything that you want. But you need to consider and try to find if there is a story. Yes, there is something that is cooking for the luxury sector. We all know that Chinese is the big market. We all know that luxury brands went all for China in the course of the last 10 years. It was not necessarily successful. We all know that. But then you need to try to find if any specific stock is more immune. This is the reason why I tend to like particularly Hermes, because even the recent numbers they published showed you that there is a will and there is a desire to own Hermes by purchaser. So it's something that makes them quite immune compared to other company of the sector when it comes to China, when it comes to the will of the new generation not to be so shiny anymore as they used as the old generation were. So I think that you need to go through specific stock in particular. You have turnaround stories also.
Francois, thank you very much. I think that's all we've got time for. I look forward to speaking to you next Monday.
Okay, have a good week. Bye bye.
You too. Bye bye.